Welcome. So in this video, I'm going to talk about the AI bubble. Right now, as you can see, the markets are terrified of an AI bubble. The market is scared when it's going up. The market is scared when it's going down. The market is scared when it's going sideways. You just can't win. I see people who are selling investments because they're afraid of the AI bubble. They think it's like the dot-com bubble. And everyone just keeps talking about the dot-com bubble. They're using terrifying and scary charts. And this is something that's really important to discuss because it applies to everyone who's investing. Whatever you're investing in, you are impacted by this. People are scared of the concentration. Overall, just fear in the market. So we need to get to the bottom of this. And I am absolutely going to get to the bottom of it in this video. You know, especially Ray Dalio recently just had an interview, I think it was on CNBC, and people have sort of taken what he said and got scared from it, even though he didn't directly say that it's just going to be a big bubble that's going to pop, like tulips in the Netherlands. So what is the main fear? So you've got lots of speculation. Speculation from people that, you know, are online, retail investors. This is why retail investors, they take localized issues that they see with their own eyes and make it like an industry-wide concern or issue. This is just natural human behavior. We don't look at concrete evidence. We'd rather just look at what we see. So we have a retail person, I think they're on like a forum or something like that. I came across it on Threads. So Anthropic IPO is proof that the AI bubble is going to pop. The way I see it, companies are rolling back their AI usage. Okay, saying it costs too much. It's too expensive. And what's happened is Anthropic sees that they can't raise their prices. I think that's what he's trying to say there. They can't raise once things are openly discussed. So they're filing for an IPO. It's a Hail Mary. Personally, according to this person called Space Alien, I personally see a recession in 1 year. AI funding is crazy. It will die down. It's the only thing keeping the economy afloat. It's being squeezed from all sides. Okay, there we have it. So we have it. Some anonymous person online has said that it's a bubble because it's expensive. So localized issue, and that's how these people make their investment decisions. This is why most people are terrible at investing. Because they just run off emotion, ego, and everything. And we don't operate on emotion. We don't operate on how we feel. We just operate on the facts. That's how we do it. Because if we run on our own human biology, it will betray us every single time. Humans are just naturally not programmed to be good investors. But let's just look at the hard facts. Okay, first things first. If the business had actual problems, the worst thing you could possibly do is file for an IPO. An IPO is being fully transparent, so the whole world can now see your exact books, and if there is problems there, they will be immediately discovered. So an IPO is a Hail Mary. It's stupid. Okay, so that's the first thing. Okay, so the fact is, this is the big one. I'm going to talk about this as well because one of the biggest things is people are like, okay, AI is more expensive than humans, therefore there's no ROI. Therefore, what's the point in it? Haha, see, humans win. Okay, this is just all coming from their own insecurity. People, it's AI. This technology is so disruptive that it is making people so insecure. Humans are reacting the same way they react to every technology that gets invented, and it's just humans are so predictable, and humans are the bottleneck to the technology. Right now, the evidence proves that people are paying for the technology. Anthropic is growing at absolute record pace. So although this person is saying, oh, it's expensive, we know it's expensive, but yet the technology is that good that people are still paying for it. And what will end up happening, I believe, is people are going to work their way around it. So they're not going to use 100% of the AI usage on like Anthropic or OpenAI. What they might do is split it, where they use some open source models using their own compute power that they save money. They'll start to work their way around the technology if it is too expensive. But the companies might just be willing to take a loss right now because it's increasing the productivity so massively. That's what the smart operators are doing, because we're now in game. It's a game theory now. It's no longer just about ROI. The people that are looking at it like an ROI are the ones that are going to get left behind violently. Yeah, people that just are stuck in their old ways of, oh, what's the ROI? Yeah, we'll look at that. We're going to look at that. So right now we have, he's saying that this person's saying that obviously the funding will dry up. Absolutely wrong. The evidence is showing that massive private equity firms like Apollo and Blackstone are using the chips as collateral. They're striking deals with Broadcom, Google, Anthropic, have made a sort of trifecta where they are accepting the chips as collateral, and Google are acting like as a buyer of last resort. So that is a very secure deal. That's a $36 billion deal for Anthropic to use their compute power. Yeah, and when you're filing for an IPO, you've got Morgan Stanley and Goldman Sachs going through everything in great detail. So no, it's not just like a cash grab. People have this big confusion of IPOs. Yeah, they're a cash grab. They are for the original engineers and the very first investors that took the most amount of risk, the people that started with the company. This is the purpose of the stock market. This is where the stock market, it serves its purpose of pushing civilization forward. If the stock market didn't exist, how would you motivate these highly intelligent engineers at Anthropic to do their job? If there was no stock market, were going to be private forever. They're never going to get incentivized to do it. So this is what the stock market is for. This is the moment that capitalism steps in and serves its purpose. So yes, that will happen. And it's common for IPOs. You know, after 6 months, the stock price usually tanks because they're all exiting after the 180 days. But no, it's nothing to do with the fact that there's a problem with the technology. Let's look at the facts. Okay, so you see this all the time. Circular financing, yeah, so big, scary, closed ecosystem. They're all just investing in each other. All of NVIDIA's revenue just comes from people that it puts its money into, and it just all goes round in a big circle, and everyone's just passing money to each other. This is another thing that the bears use, the short sellers. Yeah, it's all going to just collapse like a big bubble. Well, this is false, because this is what they're essentially saying here is all the revenue just comes from each other, which is not the case. We have external customers who are paying these companies. Okay, what is the proof? If there's an AI bubble, why has all the cloud providers earned over, it's expected to surge over $285 billion of cloud across the hyperscalers. Amazon, Microsoft, and Google. Their cloud section of the business is growing at record pace. Not all of that is from them passing money to each other. That's clearly coming from tech companies, enterprise customers, and startups and so on. That money is proof. The cloud expansion is absolute proof. Yeah, that it's not just all them paying each other. Okay, Anthropic is scheduled to earn $200 billion in revenue by 2031, according to Goldman Sachs, Morgan Stanley, and the other analysts. It is growing so violently. To put it into perspective, Meta, Facebook, what that's been around for over 20 years, I believe. 20 years, or at least 15 years, you get it. It's been around for a long time. Anthropic's going to hit what they hit in revenue last year in 5 years? That's just showing how disruptive the technology is. So the revenue's going up. But what about all this capital expenditure? This terrifies Wall Street. Everyone's afraid, full of fear and uncertainty. Well, let's look at Google, right? Google have invented the TPU chips. The TPU chips is what they use, and these are co-engineered with Broadcom. The cost of compute is violently going down. They cut it almost 70% from what it was originally costing them. The cost is going down. The cost of actually running the models is going down. There's so much evidence for this. Look at Midjourney. Midjourney's a tech startup that uses an AI image generator. When they switched to Google TPUs, they saved like 70%, 50% of their costs. The costs are going down. So the revenue's going up, but the costs of the compute is going down. That's more evidence that the technology is not a bubble. Let's go into the Michael Burry argument. Michael Burry. He says, well, okay, that's all good, yeah, these chips are all good, but they only last maybe 4 years, and they are writing on their income statements, on the balance sheets and P&Ls and things, they're writing them off for 6 years. And he says, aha, see, got you. Yeah, and as we all know, you should never borrow money longer than the life cycle of the asset. You know, if the asset only lasts 6 years, you should really only borrow money for 6 years. You shouldn't borrow the loan across 10 years or 20 years or 100 years. So what's going on here? These chips they're going to throw them in the trash in 4 years' time, and they've got all these debts and bonds running for 6 years plus. Big problem. I would accept that argument from Michael Burry if these companies were not the strongest cash generating entities that have ever existed in human history. Right, so look at this. Google, just Google, right, is expected to hit operating cash flow, right? That's cash that hits the bank, cash that lands in the bank. $252 billion. That's projected for 2027. Okay, so if these companies were a startup and they were relying on the depreciation schedules and cooking the numbers, I would say, okay, that's a genuine concern. But for one reason, it doesn't change the cash that's going into the account. It doesn't change the revenue. That doesn't change that. The fact is, you can do what you want with the net income. Okay, the net income, I've always said this, is the accountant's opinion, the accountant's illusion. It's depreciation, it's amortization, you know, it's interest, it's everything's bringing that down. But you can't hide the fact that the company's got $252 billion of cash coming in. That's absolutely absurd. That's unbelievable. Because look there, I mean, last year, 164 billion. That's unbelievable. So there's Google. That doesn't even count Microsoft and the other hyperscalers. Okay, so the depreciation doesn't change that. But the fact is, the chips actually do last 6 years. They do. Just not in their prime use. So for the first 2 years, the models are at the front line. They're getting these chips are at the front line getting used for the frontier training. After 2 years, they do something else with them. They say, okay, we'll use it for inference, we'll use it for running the models, we'll use it for something else. We'll take you off the front line, replace it with the new soldiers. The new soldiers come in, better chips, they're more energy efficient, they're on the front line. Then by years 4 and 5, they do utility and batch work, and by years 5 to 6, they strip them down, they salvage them, they take out the rare minerals, the real metals, and they use them, they recycle them, they squeeze them like a sponge, they take every piece of usage out of the asset. So for Michael Burry to say, yeah, they don't throw them in the trash after 4 years, and it doesn't change the cash that's coming into the business. Cost of compute is going down. Revenue is going up. The best proof as well for to slam the AI bubble is the fact that the revenue that's been generated from the Anthropic, because that is not just NVIDIA putting money into a customer and the customer pays them back. That's not circular finance and vendor financing. That's pure evidence that people are paying for the technology. Okay, so here's the other thing. The other argument I hear is, well, humans are cheaper than the AI is more expensive. Absolutely. Yes, absolutely. At the start, it will be. Yeah, so this is where we're at right here. Human employee versus the AI. The AI is more expensive. But as time goes on, guess what? The AI will become cheaper in line with the productivity that it does. So what happens is the old legacy customers and CFOs of these enterprise businesses are saying, well, if I don't see an ROI, we're not going to use the technology. This is classic human behavior. Humans have been the exact same when the internet was invented. It's just so predictable that the evidence is overwhelming. The smart businesses say, okay, we will take a loss right now, use this technology, because once we figure out how to use it properly and our productivity scales massively, you can, if you want, you can replace people with the AI, or you can just do more with more if the company has a lot of imagination. Yeah, it can go both ways. You can just keep all the same staff and they're all using AI and they're all 10 times more productive. The point is, 0 multiplied by 10 is still 0. It depends, it just amplifies the company. If the company's already highly productive, highly ambitious, highly adaptable, the AI will amplify that. If the company's already bloated, stuck in their ways, short-sighted, the AI will do nothing for them. It's down to the people. That will never change. That's it. Humans are humans. They will always be the same no matter what technology gets invented. So the ones that are willing to take a loss at the start and invest and use the AI, learn it, understand it, they'll win. What's so ironic about this entire AI situation? Everyone's sitting watching the hyperscalers. Everyone's looking at the hyperscalers and going, wow, they're all in a gladiator arena fighting each other to the death in an AI war. And what they don't realise is the war, they're also going to get that war as well. It's just not arrived on their doorstep yet, but it will arrive to them. All the way down to the employee. So the people are sitting watching this going, wow, that's interesting. It's just not showed up yet. But it will. The ones who are adaptable, as always, that's evolution. The adaptability is what survives. And it's the same for the technology and it's the same for the companies. I find it fascinating because it's exactly what happened in the dot-com bubble. I made a video back in the times I was using the whiteboard. I talked about this exact situation. Because what happened when the dot-com era, the internet was invented and people said we all need to panic buy computers. So companies were panic buying computers. And they says there's 0 productivity. These computers were supposed to make us more productive, but they don't do anything. Of course they don't do anything because the secretary went from using a typewriter to using a computer. They're doing the exact same thing. Of course there's no productivity. And then what they said was, well, saving things on the computer doesn't feel official. So let's just get the secretary to type it out anyway on a piece of paper, just so it's official. Or we can't trust these documents. What if the internet goes down and we lose all our documents? We don't trust it, so let's just type it out and print it anyway. That's just how humans were. And it's the exact same. Okay, so right now, if you give your employee ChatGPT, they can write emails faster. Great. So what? Okay, then they write the email faster. And what do they do with the extra time? Well, they just put their feet up. Of course, they're not going to do anything any faster. They do it faster, but then they just absorb the time to the employee. It doesn't change if the actual staff member, if they're productive with or without the AI, as I said before, the AI just amplifies them. What actually will need to happen before companies truly see the actual productivity gains from the AI is they will change the business around the technology. This is exactly what happened during the dot-com era. It's exactly what happened. It's almost just so predictable. Humans are actually the bottleneck. Humans are the bottleneck. It's happened time and time again. This is what happened during the dot-com era as well. And usually what happens is a company doesn't change unless it's forced. And the only way to force a company to change is when it's economically forced. So a competitor can undercut them. And then they say, okay, we need to now change things. They wait until it's too late. Typical human behavior, yeah? Reactive, just life happens to them. The proactive ones always win. So the proactive people, proactive companies who say, okay, let's learn this thing, let's figure this out. They're the ones that are going to survive the next generation. Because this technology is highly disruptive. So people are just stuck in the tunnel vision, ROI, where's the ROI? This is Wall Street analysts as well. Where's the ROI? And they don't see the ROI, they're not happy. They don't understand that it's deeper than just an ROI situation. The ROI will come later. It's just right now, it's game theory, it's a fight. What truly popped the dot-com bubble? Okay, first of all, let's just factor in the truth that these companies were trading at absurd valuations. The valuations were they were all trading like 200, 300 price to earnings. Yeah, that was just a total bubble. Pets.com, yeah? Pets.com was not going to make $200 billion in 5 years' time like Anthropic is doing. So it's not even comparable. What truly popped the dot-com bubble was the Fed. This is really what Ray Dalio was talking about, because he is correct when he says this. He's a macro specialist. He's a macro, genius when it comes to monetary stance. What he was really saying in a nutshell on CNBC was, if the Fed hike rates, it will pop the bubble. This is true. If the Fed just decided tomorrow, right, we're doubling the Fed fund rate, we're doubling the rate, the risk-free rate, yes, all your tech stocks would crash, because it's maths. All the big investors, pension funds, institutions, why should they invest in a volatile big tech company when they can just get a risk-free rate of like 6% on a bond? The discounted cash flow blows up all the calculations, because why take a risk when you can just get easy, cheap money? However, that's not going to happen, because we don't live in a time where the Fed just ambushes. The Fed don't just wake up and surprise, rates are high. Yeah, that doesn't happen anymore, but it used to. Look at this chart. This was the Fed fund rate, 1991 to 2006. It looks like a roller coaster. It looks like a volatile low cap stock or something. Look at it. Up and down, up and down, up and down. That is not the Fed anymore. The Fed are a stabilizer. They understand now. That's the Fed chart today. Look, it's far more predictable, far more stable. It is not a surprise. They're not going to ambush us. They use forward guidance. They hold press conferences. Most importantly, the dot plot spells out the exact rate targets. So you have 19 members of the Fed who make a vote of what's going to happen next, the way things are looking. Are they going to hold rates? Are they going to cut rates? They don't keep it a secret anymore. You're not in the dark. This is what terrifies people, because a lot of investors understand the Fed really have massive power over the stock market. And it's absolutely true. The Fed a rate hike is truly the most disruptive thing to the stock market for your tech stocks and your growth stocks. But you can keep an eye on what the Fed are guidance, what they're forecasting. So right now, when inflation is going up, like your CPI inflation, oil costs are going up, the Fed are in a position where they're going to hold rates as they are. But they're not in a position where they're talking about hiking. And if they are planning on hiking, they would make it very clear. They don't just surprise attack us. And it's not the same Fed as it was in the past. They realise that they do more harm than good by just suddenly hiking rates or cutting rates or whatever it may be. It's now more about being a stable, a stable anchor and not keeping people in the dark. The companies really need to know what the Fed is doing. Corporations don't know how they're going to structure debt or the future. Our bonds don't know what's going to happen. So this is very important. The Fed are not going to ambush you. So there you have it. I do not see a bubble. I do not see a bubble. A bubble is companies with no earnings trading at massive multiples. No one's actually spending money on the technology. That is not the case. If anything, revenues are going up. This is just Anthropic, but this is also applicable to Google. Google are seeing massive monetization from their AI. Right, Google's a great example. They're really seeing an ROI. Okay, that's what people are obsessed with right now. Wall Street are obsessed with it because they don't see the bigger picture. Compute costs are going down and revenues going up. Does this mean the market's not going to panic from time to time? Of course, the market panic all the time. Right now, Wall Street, they're the ones complaining about a bubble, but when a company doesn't tell them they're going to see astronomical revenue the next quarter, they go in a tantrum and sell the stock. Yeah, that's Wall Street for you. We can't control Wall Street, but we don't need to. We just control our investment strategy. Yeah, just looking at the earnings. That's it. That's all that matters. If the earnings are going up, the stock will go up. Everything else is noise and is to shake you out of the market, to scare you. So for people that are selling their assets because of these fears, these amplified fears from legacy media, they're making a fatal error, because this is not a bubble. This is an industrial revolution that comes around maybe once every 20 years. It's a fantastic time to invest. The dot-com bubble was like an 80% crash. I just do not see that happening. There's just no evidence that points to that. And the technology itself it creates a win-win scenario for everyone. Okay, so I'll tell you who it benefits. If AI increases productivity, that massively benefits, well, the US federal government, because this allows them to pump more liquidity, more currency. They can print more money because the productivity will absorb it. The CPI inflation will stay low. This benefits shareholders because their stocks go up. It benefits the Fed because they can keep rates low because productivity is higher. They can keep CPI will stay under control. It benefits everyone. It's very similar to the extended time we saw where the rates were held low for such a 10-year plus. Remember this era of globalization where there was low rates for a decade? Largely because of the invention of the internet and productivity skyrocketed when humans eventually realized how to use the technology correctly. So there you have it. There is no AI bubble. The technology is not a bubble. And I hope I brought enough evidence for you. And I hope you enjoyed the video.